And we are live. Welcome to Get Well with Mel, your number one source for health, care, and wellness information. I'm your host, Melissa D. Hall. And today, we have an informative show today. And it's all about the high cost of living in America. The first part of our show, we will explore rising healthcare costs. As we all know, the government shutdown is over, but the fight for healthcare is still ongoing. ACA subsidies have not passed. And on the Medicare side of things, hospitals and doctors' offices just can't reach an agreement, leading to plans leaving areas across the nation and leaving our seniors without health care. After that, I have a very special guest, actually two special guests today. One, you're going to hear from an American citizen just like you and me, who's having to deal with the high healthcare costs because these subsidies are not passing. And then after that, I have a very, very special guest, real estate expert Bobby Arukwe. He has been a staple in the Raleigh real estate industry for over 4 years now and has helped dozens of homeowners achieve the American dream. He will explore with us Trump's latest proposal to stimulate the housing market, which is number one, 50-year mortgages. Are they beneficial or not? He has the answers. Also, we will explore Fannie Mae's latest decision, which is getting rid of credit score minimums. So, as you all hear, we have a lot to unpack today. So make sure you tell a friend and share out this broadcast and get your pen and paper because it seems like an episode that you're going to need to take some notes to. Welcome to Get Well with Mel. All right, so like with every show, you all, I have to go ahead and share this out on my social media channels. And while I'm doing that, you do too. And listen, I see you all watching, okay? So go ahead and say hello to me. Listen, I have really been going back and forth about pre-recording this show or not. So tell me, what do you all think? Should we keep it live or should we pre-record it? What do you all think? I'm thinking we're going to keep it live, but let me know in the comments. Should we keep the show live or should we pre-record it? I love the live feel of things because I feel like it helps build community. However, I'm open to whatever you all think. Let me know in the chat. Also, another thing, you all, the show has definitely evolved beyond health and wellness. And so I'm looking for a new name for the show. If you all follow me on Facebook and Instagram, you all have seen, and also LinkedIn, you all have seen the different posts that I have put out looking for suggestions. One of the names that we are considering is Live with Melissa D. Hall. Another name that was put out there that I kind of like is Mel in Motion. Caroline Abbas, you said live is good. You like live? Live with Melissa? Oh, you want to keep the show live. Okay. All right, good, Carolyn. Thank you so much. And make sure you share this out. I like live too. The only reason why I wanted to do pre-recorded, shout out to Deborah Boston. How you doing, Deborah? The only reason why I wanted to do pre-recorded is because I wanted to be able to kind of do more episodes. When it's pre-recorded, it allows me to do more. So that's why I was kind of thinking about it. But I think we are going to stick with live. What about as far as a name for the show, right? I'm thinking, what do you think about Mel in Motion? Or should it be Melissa D. Hall in Motion? Let me know. All right, so let's get to the first stop of the day, y'all, Medicare. Okay, for those of y'all who do not know, I have been helping seniors with Medicare, you all, since 2017. I've been in the health insurance and senior market since 2008, right? So this is my jam. This is what I do. And currently we are experiencing what we call the annual enrollment period happening from October 15th through December 7th. All right. And this is a time where all 37 million people who are on Medicare Advantage, right, who are on Medicare Advantage, they get to change their plans, okay? And just to break it down even further, those of y'all who do not know, Medicare Advantage plans are plans that private companies like the Aetnas and Humanas, right? They are contracted with the government. So the government pays them to give you all these plans to fill in that 20% that Medicare doesn't pay. You follow me? Okay. So what is happening this year, you all, because each year they have to renew them, are a lot of these plans are leaving the market. Like in Maryland, right, in the Baltimore area, I've talked about this several times on the show. I have seen, Aetna leaving, United Healthcare leaving. They're leaving the area, basically leaving these people stranded. And it's not just them, it's happening all across the US. In North Carolina, right, we have seen these plans cut down tremendously. And if it's like with a higher out-of-pocket cost, I have seen plans, usually their out-of-pocket cost would be $3,500. All right. Now the out-of-pocket costs on these plans are $9,000. $9,000. They're cutting away over-the-counter benefits. They're cutting away like some of the food cards. They're cutting away, they're increasing how much you have to pay to see the specialist. One plan I'm seeing, they went from a $35 to $55 to see specialists, which is significant for people who go a lot. When you're a senior, you have to go to the doctors more. Even more disturbing, okay? And if you're out there and you're just tuning in, I am talking about the changes that I am seeing to Medicare this year that is contributing to rising costs. And if you are experiencing the same thing, let me know in the chat. Let me know in the chat so everybody knows it's just not me, okay? These are real things that I'm seeing happening to my clients daily, okay? Another thing that is happening is that hospitals, provider practices, and insurance companies are not able to come to an agreement. Okay, what does that mean? I'll give you an example. Here in North Carolina, right, we have a big hospital system called Wake Med. They're big in Raleigh. They're an amazing hospital system. Well, guess what? They weren't able to renew their contract with United Healthcare. And this is happening in the middle of open enrollment season. This isn't something that's starting the first of the year. It's something that's happening now. And how the rules of Medicare are, these people are stuck. They can't just go get another plan just because their doctor's no longer there. So they have cancer treatments, kidney treatments in the middle of getting pre-approved for surgeries. They're SOL. Okay, they're SOL until next year because hospitals and provider practices cannot find an agreement. Okay, so you may be saying, well, Melissa, why can't they find an agreement? I'll tell you why. So what is happening that we're seeing is inflation. Doctors' offices are saying, hey, it's costing us a ton more money now to provide care due to inflation, having to pay their hospital staff, the tariffs, the cost of care, all the things. And what we have seen is with the big, beautiful bill, at first, they were going to give all the doctors, right, in hospital systems increases based on the inflation in their area. For example, Miami-Dade County in Florida is one of the higher reimbursement tiers for Medicare. Well, with the big, beautiful bill, they scratched all that. And now they're giving everyone a flat 2.5%. Okay, so that's an issue. That is a big issue out here. Okay, because it costs a lot more to treat a person in Miami versus treating a person in Kentucky, right? Just even with the wages, with the cost of living. And if everybody's getting a 2.5%, come on. Also, I think another thing that needs to be stated here, because a lot of times you all hear, oh, well, they're just reimbursed at the Medicare rate. No, these hospitals are not just being reimbursed at the Medicare rate. A lot of times, these hospital plans are being reimbursed at 3 and 4 times the rate allowed by Medicare. And on top of that, they want insurance companies to help pay for some of these hospital bills over and beyond that. So it's a lot. And, the insurance companies, they're exercising their due process by saying no, and the health providers, they're offering their due process by saying no. And who's stuck in the middle are our seniors, right? People like you watching. And I'm going to tell y'all, I've been in this business for a long time. And this is the worst I've seen it. Like, I'm also seeing, for example, like Health Spring, Health Spring, I'm seeing Aetna, Humana, all of them, they're not renewing their contracts with major medical centers. And what it does, it reduces the choices that you have for care. Because if you only have one plan, and let's say that one plan doesn't cover your drugs, okay? They don't cover your drugs, they won't cover your surgeries. It's leaving seniors in a bad position, okay? And I'm just sharing you all what I'm seeing here. So, what is the solution? Let's talk about that. One of the big solutions that I am telling people right now is that you want to self-insure, okay? So, what is self-insure? Meaning, they have these things called hospital plans. So right now, if your maximum out of pocket is $9,000 and you're a person that goes to the hospital, often, right, and it's $400 a day, you can buy a plan that's like $40 a month and will give you all the money back if you have to go to a hospital. If you also, if you go to the hospital, or if you haven't got there yet, right? Because with these plans, some of them are guaranteed issue. Some of them, they look at your health, right? But I'll give you this one, and then we're going to move on to what's happening with ACA, because that's a whole thing. Okay. So last week, I had a client call me, and I'm not going to tell you where she was at. I'm not going to tell you which insurance company it was, but this was a long-term client, y'all. And y'all, this lady, she was in a hospital, and she lives with her 90-year-old mother. And she said, hey, I can't take care of myself. She had a major surgery, and she wanted to be put in a assisted living. Well, like, let's say short-term care nursing home, right? A rehab facility. That's the name for it. She wanted to be put into a rehab facility until she got back on her feet. And she called me in tears because the insurance company denied her. Even though she could not take care of herself, they refused to put her in a rehab facility. So I'm making phone calls on her behalf because she called me to tell me what's going on, trying to talk to the insurance company for her. And they said, well, listen, basically, that's not our problem. The fact that she cannot take care of herself is not our problem. She's stable. She can go home. We'll send a person in there for 3 days. Who's supposed to take care of her? Her 90-year-old mother. Make it make sense. Make it make sense. But that, you all, is what is going on right now. And the only thing that lady could have done at this point, if she would have had it, they have these policies called short-term care policies, where they would actually pay cash money for somebody to come and take care of you if you have to go home like that. Because unfortunately, a lot of times with medical situations, money solves all things, right? So if she would have had a program like that, she wouldn't have to figure out how her 90-year-old mother is going to take care of her. And I'm just showing you all about how ruthless things are getting right now. So self-insuring, looking at your policy, figuring out what the gaps are and how you're going to fill them. If you've been to the hospital and you know you can't afford that $400 a day, figure it out. If you live alone, right? Or if you have somebody who's elderly living with you and you know they can't take care of you, your kids got to work, well, you need to figure it out who's going to take care of you. Because at this day and time, people cannot afford to quit their jobs and take care of you. And that's just kind of where we're at, in China, they actually, like, it's a law that you have to take care of your elders. Do you know that? In China, it is a law that you have to take care of your parents. And I'm so happy they don't have that in, in the United States, because we got to work, right? So moving on, y'all, I hope you all like that knowledge that I just dropped for you all. Type self-insure, okay? Wherever you're seeing this, you have to self-insure. So as you all know, the government is back open. The government is back open, but guess what? Healthcare subsidies still have not been extended. And I'm telling y'all, the prices are out of control. Now, Republicans, in order to extend this, to extend the subsidies, they're saying that they want the Democrats to put more provisions or restrictions on paying for abortions. Democrats are saying, hey, those restrictions are already in there. As you all know, Planned Parenthood has already been defunded, okay? And, this is the crazy thing about it. Whether you're pro life or not, who here, let me know in the chat, has heard of the story about the lady in Georgia who became brain dead and she was pregnant? Do y'all remember that story? And they still made her have that baby? Like they kept her on life support while the baby grew, right? You know, this is the thing. We gotta have certain provisions in there because there are times like women are actually dying, okay? Because there are times, let's say if something's wrong with the fetus, if the mother's life is in danger, those things have not been ironed out yet in these rules. So I'm just like, hey, if you're gonna make provisions like that, you definitely need to iron out the rules because it's a lot of people making decisions for women's bodies who aren't women and is definitely leading to death, right? So another thing, President Trump, he has proposed having short-term care plans. Who here has heard of short-term care plans, right? So short-term care plans, these are insurance plans that are actually called short-term care. It's to be used in the interim. Let's say if you're going from one job to the next, or let's say if you retired early and you need a plan until you're eligible for Medicare, they'll have these short-term care plans. The thing about short-term care plans is that they do not cover like major surgeries, operations, mental health, maternity, prescriptions. They're not designed for that. They're mainly designed for like catastrophic things, right? If you don't have any heart issues and you have a heart attack, right? You have something to cover you. That is what they're designed for. They're not designed for physicals or anything of that sort. But his whole thing is, hey, we'll push people to that route, and also we'll give them money to buy their own coverage. And he was proposing like $2,000 is what the proposal is, when the average policy, especially nowadays, is costing, 400 or 500 a month, which we're going to get to in a second. So that is not even a real solution. And according to Kaiser Family Foundation, they said that if if President Trump's plan is enacted, as far as giving people money and letting them buy their own health insurance, it would totally decimate, okay, the ACA market, because then all the healthier people leaving all the sick people, all right, and the insurance companies just can't handle all that risk. So that has kind of been a non-starter, but that has been something thrown around there. And, I don't know if you all have seen my interview on the World News, but when it comes to the increase, these prices are going up crazy. I mean, you're about to hear from Miss Rita out of Virginia. I have literally seen people's prices go from $180 a month, okay, to down $500, $700 a month on up. And that's just for a single person. All right, this is happening everywhere. And just so you all know, when it comes to those affected by these rising healthcare prices, 3 in 4 people who are affected by it actually live in a state that Trump won. So these are Republican states that are being affected, not just, blue states, right? So it is affecting everyone around the country. So I'm going to go ahead now and I'm going to bring up Miss Rita Stewart out of Virginia. All right. Hello, Rita. How are you?
Hi, Melissa. How are you? Thank you for having me with you this evening.
Fantastic. Yes, I'm so, so excited. So, Rita, tell us here. I know you're on the ACA Marketplace. Is that right?
That's correct.
Fantastic. So, tell us, what was your premium last year?
Last year, my premium was $169 per month.
Okay. And what is it now?
And as of 2026, when I went to look out there to see what it was going to be, it's going to be $449 per month. That's a
400.
200, yes, a 265% increase, Melissa.
Oh my God. That's like a small car payment.
Yes, 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 it is.
Wow. Wow. So let me ask you, have your like out of pockets changed or copays changed or anything?
That's a good question. When I started from the beginning, when I joined the marketplace, I set myself with a deductible of 6,500 and then
Hmm.
my out of pocket at about $10,000. I have not changed it. So my intention was, to be reasonable in terms of what I would expect to pay myself out of pocket. So I've left it the same, haven't adjusted it, and still that's the increase that's slated.
$6,500 is actually quite a bit.
Wait, that's what I say. That it
Yeah.
was already a lot in terms of my deductible. So I wasn't trying to like get off easy, if you will. I was willing to do
Yes.
what's necessary to have the, coverage.
Wow. 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 So let me ask you, are your doctors still in the same network?
That's a good question. So far, I have been able to continue with my doctor of choice, and I'm very, very grateful for that. I expected that there would be a change and increase of some sort in light of everything that's happening in the marketplace. I'm not sure I expected it to be that much of a change.
Hmm.
Um, One of the questions that has been asked is whether or not my income has changed drastically, like since then, or what may have been the cause of that. And I will say, yes, my business has grown since then, but I also had a role or a job as a hospice chaplain as well. And
Wow. Okay.
I stepped away from that in early 2024, like the end of March 2024. So in essence, it's almost like a wash in terms of my income changing. So we will see. We will see. What will happen in terms of my growth this year and what will happen. But yet and still, I wanted to, have this opportunity to talk to you, Melissa, because I am an everyday entrepreneur out there, just like many others. And the goal was to keep ourselves covered. But I don't think any of us expect, regardless of where the dollar amount or premium amount is, a increase of that amount.
Wow. Yeah, no, absolutely. I mean, you're an everyday person. I don't know
Yes.
how you're going to afford, this like crazy increase.
Yes.
This crazy increase. Like, have you thought about will you have to cut back
Well,
in
for
any
me
way?
personally, that coverage, by the way, is just for myself. So it doesn't
Okay.
include coverage for my spouse or coverage for children. My daughter, our daughter's an adult. It's just for myself. No, I mean, I will be okay. We will be able to, pay the premium, which is why I went ahead and looked out there now to see what was coming. But that's not
Hmm.
going to be the case for everyone. That's not going to be the case. For many, it could mean, like you say, $469. That's somebody's car payment, or half of whatever other expense that they may need to have. That could be their utilities, and that could be a problem with an increase like that.
Absolutely. And especially like in the state of Virginia, too. I know you all are going through with this whole data center thing and the rising cost of utilities as well. So that is a big deal. And honestly, $460, that's on the low end.
Wow.
Okay.
Yeah.
Yeah, that's on the low end. It's people out here who are literally getting bills for $2,000.
Yeah.
$2,000. And so I want to address one of the things. So it was a whole big kerfluffle between Roland Martin and Charlemagne from the Breakfast Club saying, hey, the premiums are set in stone. It's nothing that can be done, give up the fight. Well, let me tell you all this. If, well, first things first, the insurance companies, they submitted two rates, you all. They submitted two sets. They submitted one set if the subsidies were extended and one set if they weren't. So, meaning they saw this conflict coming from a mile away. All right. They knew it was going to be a fight to the end. So, if the subsidies are extended, which I do think they will be extended because the Republicans had a really bad a week ago, 2 weeks ago, in the special elections that happened. But when these subsidies are extended, they will have what they call an SEP, special election period, that will allow people to go ahead and re-enroll at the new rate. Alrighty. So you all will have that opportunity once these subsidies are extended. So I know that the Republicans, they promised to have some type of vote or at least bring it to the floor by the second week of December. So we should all hopefully know something then, because people aren't going to shut up about this. This isn't going to be something that you can sweep under the rug, right? Because this is really affecting people in real time. And one thing I know is people aren't going to go back to not having health care.
No.
They're not going to do it. They're not going to do it. Too many people need it. So y'all, we got to keep the pressure on them. And there is still hope. There are things that can change. A special election period is something that happens all the time in health insurance. Okay. It happens all the time in healthcare. So we definitely want to keep the pressure up. One of the things you all can do is just write your congressman. You can call Congress, call the Senate, just call them. Literally, they want to hear from you, your constituents, and just keep the pressure on them because it is working and it's on everybody's mind. Okay. It is
And
on.
you, excuse me, Melissa, and I would just say be proactive like I was. Go ahead and figure out what that projected, premium is going to be so that you can start to position yourself one way or another.
Okay, yes, absolutely. Absolutely, definitely. You want to position yourself, go ahead and look at it. And again, you might have higher out-of-pocket costs, leading back to what I said earlier regarding insuring yourself, making sure you are reinsured. You definitely want to go ahead and do that. All righty. So thank you so much, Rita.
You're welcome. Have a good evening.
You too. Have a good one. I appreciate your time.
You're welcome.
All right, you all. So listen, we heard live, okay, from somebody who's out there, a citizen just like you and me, who is experiencing these high costs, y'all. And it is real. I wanted to bring her on. She's in Virginia. She's in a red state. She's a business owner, working every day like you and I, taking a job here and there to make ends meet. She's not making a ton of money, but yet her premium's going up. Y'all heard about 246%. It is a real thing out there, y'all. So listen, listen, listen. Our guest, Bobby, I'm looking here. I don't think he was able to make it today. Okay, we might have to have him back on another day. But we were going to talk about the 50-year mortgage that was proposed. All right, I've heard both sides of this coin, that it would take people longer to pay off their houses. I've heard that it would open the door for more people to get homes, on average, reducing mortgage costs. Oh, hold on, Bobby's here. Okay, look at that. Look at that. Let me ask him. Let me add him to the stage. Hey, Bobby, how are you?
Good evening. Mel, how you
Okay, you
doing?
made it. I'm fine. I'm fine. Happy you made it.
Thank you. Thank you.
Yes, yes, yes. So listen, tell us all about the 50-year mortgage. Do you think it's a good idea?
The 50-year mortgage. So there's been a lot of talk about the 50-year mortgage. And
Mhm.
yeah, I would like to talk about some pros and some cons of that. Um,
Okay.
yes. So, uh, for example, the median home price in the U.S. is about $400,000. On a 30-year mortgage, in this scenario, the monthly payment, let's say the monthly payment is about $2,200 to $2,300, and the total
Hmm.
interest paid over 30 years on a loan like this is about $400,000 already. We're paying a lot of money on interest on these loans.
Hold
On a
on. You said hold on. The total interest on a 30-year mortgage is how much?
$400,000.
On
After
how much?
30 years, you would have paid at a 6%. at a 6% interest rate, after 30 years, you would have paid 400,000 in interest.
On a how much of a home?
$400,000 home.
So you basically pay for the home twice.
That is how much interest affects the homes, and that's why people always want to
Wow.
get low rates. But on a 50-year mortgage, okay, on a 50-year, your payment would be $2,000, right? So on 30-year payment,
Mhm.
it'd be about $2,300. On a 50-year mortgage, it would be about $2,000. But however, the total interest paid over 50 years will be about $800,000, right?
Wow. That's
Yeah,
crazy.
especially since a mortgage that has a longer life will probably have a higher rate. Okay.
Mm,
So if you
okay.
raise that by 0.5% and you're paying a 6.5% rate on a 50-year loan, the monthly payment goes up to about $2,100, but the total interest paid is going to be about $900,000. Okay.
That's that's ridiculous. That's
So
ridiculous.
and the other con to it is that on a 50-year mortgage, the pay down at the end of year 5 is like $7,000, right? So like most people sell their homes within 5 to 10 years of living in the home. Okay.
Mhm.
Um, you will not really have paid much on your home on a 50-year mortgage. So now
Mm,
this turns into an investor game, because investors are the ones who can really benefit from this because they'll have low monthly costs and they will be able to get out of the deals fast. So this would
mm.
be a position, a good opportunity for investors to take advantage of.
Wow, thank you so much for that. I didn't even think about that. Okay. So you said investors will be able to get out of the deal fast. What do you mean by that? Tell me more.
So if there are any investors listening, and what I don't know for sure is what financial institutions are already offering a
Hmm.
50-year mortgage and which ones aren't. But because investors are big on being in for a few months to rehab a home and basically selling and flipping, they will
Hmm.
not suffer they will not suffer the interest, the high interest that someone who a normal person who just wants to get their foot in the door, and this 50-year mortgage is the only way that they'd be approved for a mortgage, but they're locking themselves away into a 50-year interest consuming debt.
Wow. Okay. Okay. So let's talk about that. Okay. First of all, you mentioned that you don't know who does it. So these 50-year mortgages are already out there.
That's what I was basically still studying. I haven't run into one yet.
Okay.
So I'll probably do some calling around. So I don't know if it's being offered quite yet. I don't know if it's being offered yet, but it looks like something that's going to be on the table soon. And
Hmm.
it's a way to help some people. It's a way to help some people get into a house because the monthly payment will be lower. So it helps your debt to income ratio.
Hmm.
Yes, and so that's how the 50-year mortgage helps people, and that's how it also helps investors because they can get in at a 50-year mortgage and sell the house within 4 months and barely spend any money at all.
Okay. Wow. Thank you for enlightening this us on this. Those of you all watching, let me know in the chat. Is this new news to you? Do you all think that a 50-year mortgage is a good idea? I did take a survey on my Instagram about it, and the responses were split. Half said it was a good idea, and half said it wasn't. And also, just wanted to remind you all to follow me on Instagram at Melissa_D_Hall. Also, if you would like the replay to this episode, if you go to melissadhall.com /get well with Mel, it's a little form there. You just fill it out, and I send out the replay to everyone on that list. Okay. So somebody wrote something. Oh, hello, Abdul. How are you, Abdul? Abdul, what do you think about this whole 50-year mortgage? Do you think it is a good idea or not? Just for you all tuning in, I do have Mr. Bobby Arukwe. Hopefully, I said his name right. He is a real estate agent here in Raleigh, North Carolina. You can follow him online on Instagram. He's very active at Raleigh Reps, RALEIGH Reps. Right there, you can contact him from your home buying needs. How long have you been in the real estate business, Bobby?
I've been in the real estate business about 10 years.
Okay.
Yep, about 10 years,
Also,
approaching 10 years. Yes.
oh wow, so you've helped a lot of people.
Yes, 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 absolutely. A lot of my first clients have made a lot of money just by living in their homes.
Really? Okay. Okay. Yeah. And that's why this is so important with these mortgage changes because for most people, most American families, they're making their wealth, they're building their wealth by owning a home.
Hmm.
They are building their wealth. So next up, Bobby, another thing that was just instituted was Fannie Mae. They got rid of the credit scores. Is that right?
Um, so it kind of works a bit different, right? So they're saying that Fannie Mae announced that they're removing the 620 minimum credit score requirements for its automated underwriting desktop system. So they called it BU, the desktop underwriter, starting November 16th. That means that the desktop underwriter will no longer automatically reject borrowers just because the score is below 620. Instead, it'll look at the full picture, debt to income ratio, equity down, payments, savings, everything that can to determine whether it's a worthwhile risk or not. So this sounds like great news for people with lower credit scores, sort of, but there are some important caveats. Before, you needed at least a 620 score for a conventional loan to pass automatic underwriting through Fannie Mae. Now there's no fixed credit score, and the decision will come down to how strong the rest of your profile is. Fannie Mae made this change to bring the underwriting in line with Freddie Mac's system, which evaluates overall risk factor rather than relying on a cutoff number. So what does this not mean? It does not mean that anyone can now qualify regardless of a credit score. Remember, private mortgage insurance, or PMI, requires at least a 620 credit score if you're putting down less than 20%. So if you have less than 20% down, your loan needs PMI, and PMI companies have not changed their guidelines. So even if Fannie Mae allows it, the PMI provider would not allow it if you were not able to put down a full 20% down payment. Automated underwriting looks at the entire picture. So there's low credit scores, high debt to income, little savings. You will still not be able to qualify for the loan. If you have a bigger down payment, solid income, and several months of reserves, you could pass with a low credit score. And so that's what it basically means. Lenders are now able to set their own credit minimums, and they offer and they keep 620 as their minimum. Most of them will keep 620 as their minimum to match what a private mortgage insurance company would want for their mortgage. So just to wrap it up, basically, um, it's not that anyone can apply for a home or that your credit is not being run. Your credit still gets run. They just don't immediately disqualify you if you fall under the credit minimum.
Okay. So, question for you. Okay, let's say if they don't use your credit score, does that mean that you most likely have a higher interest rate?
So there is a usual connection between credit score and interest rate in lending, and so that is likely to be sustained. Yeah, just because sometimes interest rates can be higher with lower scores because of a higher risk factor. Um, but for the most part, rates are at what I would consider a more stable point. They don't really need to go up or down too much. I'm sure most people want them to come down a little bit. If they come down too much, we will we will have another market crash. As a matter of fact, right now what we are experiencing is a market bubble that has come from low rates during COVID and also pushed up prices during COVID. A lot of companies, a lot of huge companies bought lots of houses during that time period, and they paid over asking price, as well as a lot of remote workers buying homes during the COVID period and the work from home explosion. A lot of homeowners started buying homes in other areas where the houses were less expensive, and they were able to pay higher than asking price for 2020 through about 2024, I want to say, or 21 through about 24 or 23. No one was paying asking price for homes. Everyone had been paying above asking price for homes. So that's how we got into the bubble we are. Bringing the 50-year mortgage back, this could also hurt our bubble as well. For example, let's say I can afford $3,000 a month, right? Let's say I can afford $3,000 a month. And let's say I'm in a bidding war for a home that is currently going to cost me about $2,200 a month. Well, I can turn around and say, hey, just give me a 50-year mortgage for an amount of a home that'll cost me $3,000 a month. And so let's say the home is $300,000. Maybe they jack the price up to $340,000 because now it's a 50-year mortgage, and now I can still qualify for it, but I can still be more competitive than anyone else on the market. Guess what that does? That makes the prices go back up again.
Okay. Question, Bobby. Do you have me on any other device this stream?
Not at the moment.
Okay, no problem. Because somebody mentioned the echo. That's all. Just making sure.
I heard it for a little bit, but it seems to be gone now.
Okay, yeah, it seems to be gone, y'all. If y'all hear it, y'all just let us know. Carolyn, she was letting us know. So, okay, like that's wild. That's really wild. So, when it comes to the whole no credit score, do you also think that is another thing that might be good for investors as well?
Fannie Mae, I want to say, is usually a more residential loan orchestrator.
Okay.
So for the most part, it'll be affecting people that are buying residential homes. However,
Okay.
the same thing could apply. If you were a young investor and you wanted to try something new, and you didn't have the best credit, but you had money, because that's the thing. It's just a matter of how much money you have as opposed to how much credit you have. So you have money, you don't have the credit. Well, now, now you can start that process a little. You may have a chance to start the process where you would have had to go through some other type of institution to even try to get financing of that sort. So it could be good for new investors or new
Okay.
homeowners as well. By the
Good.
way,
Well,
if anybody out there needs more help on any of these, or does not have enough for a down payment, but you do make money, or you make enough money to handle a mortgage every month, give me a call. I can put you through a program that can get your down payment taken care of for you. And that'll be back to you, Mel.
oh, you're fine. You're fine. Well,
There
that's
she is.
great. What type of I guess program is that called?
Unmute yourself for a little bit, all right?
Am I muted? Oh, am I muted? Oh, somebody asked, can you help in Texas?
Still waiting for a signal.
You can't hear me? I think they can. Y'all, let me know. They say, can you help in Texas? Okay, they said they can hear me, Bobby. I don't know why you can't.
So guys, I'm gonna I'm gonna
All right.
switch
Let's-
back in here in a second, okay? I'm gonna
Okay.
switch
All right, no
locations
problem.
and
We
jump
can
back
hear
in.
you, Robin. Okay. Well, I guess he'll be back on, y'all. He said, "Can you help him in Texas?" Hey, he might be able to. Yeah, I think he can actually help you in Texas. Okay, Nakia, y'all can hear me. Okay, good, y'all. All right. We listen. This show has come a long way. We have gotten past a lot of the technical issues. So I'm proud of me. That was really good. Listen, the housing market is so interesting now, especially because we have a president who is a real estate investor. And so you can definitely see like that's his thing to tinker with is the real estate market and make that go. So I think that we are definitely in for a couple of great years in real estate with him in office. So that's something I'm looking forward to. Carolyn, she said, congratulations. Thank you. All right, what's up, Chris? Nice to see you. Listen, saying hey to some of my OGs. What's up, Chris? Thank you for tuning in. I know you became a homeowner recently. Shout out to Caroline. You're new here, Caroline. Welcome. Listen, we go live every Thursday at 5:30 p.m. Eastern. Yes, we can help you in Texas, Nikia Holly. Let me tell you all about next week's show while we wait for Bobby to come back online. So next week, we're going to have another Bobby. His name is Bobby Bostic, okay? At 16 years old, he was sentenced, you all, to 126 years in prison for armed robbery. And get this, he was freed by the same judge that sentenced him. Yes, 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 yes. And now he is an author, an entrepreneur, and he's helping other youth uh, not to make the same mistake that he did. So that is going to be an amazing episode. Have you all ever heard of him before? He's been profiled by Gayle King. He's been on Good Morning America, on every news outlet. Yes, wow. And the judge, again, she's the one who advocated him and freed him. And he's just such a dynamic person. And one thing I love about the story is definitely his testimony, but also that you can change at any age. You can right your wrongs at any age. And so his story is going to be amazing because next week is Thanksgiving. We're actually going to have our show on Wednesday at 5:30. So tune in for that. Again, if you want to go ahead and join our list to make sure you get a reminder, if you go to melissadhall.com/get well with Mel. All right, and I'm letting it scroll on the bottom here. If you just go there, y'all, you can fill out the form. It sends out the replay. I send out reminders. That's what a lot of people here got to join in, and we can see their comments. It just really gives you an inside experience. So just go right there. I don't spam you, okay? And you can get the access and the replay and make sure you're reminded of this episode. So yes, it should be interesting. It's going to be very interesting. He's a very dynamic person, very calm, very centered. He's a very powerful person. And while he and I were talking in pre-production yesterday, I asked him, I said, what did you think when that happened? I said, did something in you say you were going to make it out? He said, I just knew it wasn't right. He said, I just knew it wasn't right. I knew something was going to be done. I just knew it wasn't right. And I think that is a real testament to faith. He is a man of faith because, he just never gave up hope. He got a degree while he was in there, and he's written like 17 books. And you all can Google him before this. His name is Bobby Bostic. So I'm excited about that. All right. So it seems like Bobby's not going to be able to make it back. Y'all, I appreciate y'all tuning in. Make sure y'all share out this episode. I am definitely going to have Bobby back because he was rolling. Okay, he was definitely rolling. I'm going to make sure I have him back. And make sure you tell a friend to tell a friend. Thank y'all for joining me on Get Well with Mel, y'all.